When you're just getting started with investing, it can feel like you're standing in front of an endless buffet of options. Stocks, bonds, crypto, real estate, index funds, mutual funds, and of course, ETFs. It's easy to get overwhelmed by all the acronyms and opinions, especially when every financial influencer claims to know the best path to wealth. But if you strip away the noise, there's one type of investment that consistently stands out as the simplest, safest, and most effective starting point for beginners: exchange-traded funds or ETFs. The question is, with thousands of ETFs out there, which one is actually the best for someone who's brand new to investing? That's exactly what we're going to break down today, step by step with no fluff. So by the end of this video, you'll know which ETF deserves a spot at the very top of your beginner portfolio. To answer that, let's first get crystal clear on what makes an ETF so beginner-friendly. An ETF is essentially a basket of investments, stocks, bonds, or other assets, all wrapped up in one simple package that trades like a stock. Instead of buying one company at a time, you're buying tiny pieces of hundreds or even thousands of companies at once. That instantly gives you diversification, which is a fancy way of saying you're spreading out your risk. If one company tanks, it barely makes a dent in your overall investment. Contrast that with owning a single stock. If you put all your money into Tesla and it drops 20%, your portfolio just got crushed. With an ETF, that risk is smoothed out. On top of that, ETFs are cheap, easy to trade, and don't require you to be some kind of Wall Street analyst. They let you own the entire market without spending your entire life studying charts and earnings reports. Now, with the basics in place, let's tackle the main question. Which ETF is the best starting point? The truth is, if you ask 10 financial experts, you'd probably get 10 different answers. Some would push bond ETFs for stability, some would say dividend ETFs for income, and others might suggest sector ETFs for growth. But when it comes to beginners who want simplicity, broad exposure, and long-term growth, the conversation almost always comes back to one option: an ETF that tracks the entire US stock market. Why? Because the US market has historically been one of the strongest wealth-building machines in the world. By investing in a total market ETF, you're betting on the long-term growth of thousands of American businesses, from Apple and Microsoft down to small up-and-coming companies you've never even heard of. So let's get specific. There are a few total market ETFs out there, but the one that consistently comes up as the gold standard is the Vanguard Total Stock Market ETF, better known as VTI. This fund owns over 4,000 different companies across large, mid, and small caps, giving you exposure to virtually the entire US economy. With one purchase, you instantly own a piece of tech giants like Apple, retailers like Walmart, healthcare leaders like Johnson & Johnson, and thousands more. The expense ratio, which is the annual fee you pay to own the fund, is just 0.03%. To put that in perspective, if you invest $10,000, you'll pay only $3 per year in fees. Compare that with the typical actively managed mutual fund, which can charge over 1%, and suddenly you're saving hundreds or even thousands of dollars in fees over time. That difference compounds massively when you're investing for decades. But here's the part that makes VTI particularly beginner-friendly. It doesn't require you to predict winners. You don't have to choose between Tesla or Ford, Amazon or Walmart, Nvidia or Intel. You own them all. If one company struggles, another picks up the slack. Over time, the US stock market as a whole has returned about 9–10% annually, and VTI mirrors that performance almost exactly. For a beginner, that means you don't have to time the market, chase trends, or constantly worry about rebalancing. You just buy it, keep buying it regularly, and let the market do the heavy lifting. Of course, some people might argue that an S&P 500 ETF, like Vanguard's VOO, is a better starting point. The S&P 500 tracks 500 of the largest US companies and is often used as the benchmark for the entire market. And honestly, you can't go wrong with that either. It's a fantastic choice. The difference is that VTI includes not just those large-cap giants, but also mid-cap and small-cap companies, giving you slightly more diversification and exposure to areas of the market that could grow faster. It's like owning the S&P 500 with some bonus coverage. The performance difference isn't massive, but over decades, having that little extra diversification can pay off. Now let's address one of the biggest concerns beginners have: risk. When you hear stock market, you probably picture wild swings, booms, crashes, and people losing everything. And yes, in the short term, the market can be volatile. You might see your investment drop 20% in a bad year. But here's the key. Over the long term, the market has always recovered and gone on to hit new highs. Look at history: wars, recessions, crashes, pandemics. The market always bounced back. If you're investing for decades, those short-term drops are just noise on the way to long-term growth. With a fund like VTI, the risk of one company going bankrupt doesn't threaten your portfolio. That's the beauty of diversification. Another reason VTI is perfect for beginners is automation. You don't need to micromanage it. You can set up automatic investments through your brokerage account, $50, $100, $500 a month, and just let it build. This strategy, called dollar cost averaging, means you're buying consistently whether the market is up or down. Over time, it smooths out your cost basis and reduces the emotional roller coaster of trying to time the market. For beginners, that discipline is priceless. But here's where beginners can get tripped up, thinking that VTI is all you'll ever need forever in every situation. While it's an incredible foundation, it's also 100% US stocks. Some investors like to add an international ETF like VXUS to capture growth in foreign markets. Others add a bond ETF for stability, especially as they get closer to retirement. That doesn't mean you should overload yourself with a dozen ETFs from the start, but it's worth knowing that VTI is a starting point, not necessarily the finish line. Still, if all you ever did was invest in VTI consistently for 30 years, you'd almost certainly end up far wealthier than most people who try to outsmart the market. To give you a sense of what this looks like in practice, imagine you invest $500 a month into VTI starting at age 25. If the market returns its historical average of around 9% annually, by the time you hit 65, you'd have about $1.6 million. And that's just from steady, boring investing, no day trading, no picking hot stocks, no gambling on crypto. Just a single ETF that does all the work for you. That's the power of simplicity. And that's why so many financial experts recommend it as the best starting point. So let's tie it all together. The best ETF for beginners isn't necessarily the one with the flashiest marketing, the highest dividend yield, or the latest trend attached to it. It's the one that gives you broad exposure, low costs, proven long-term growth, and maximum simplicity. And right now, the Vanguard Total Stock Market ETF, VTI, checks every single box. It's not glamorous, it won't make you rich overnight, but it's steady, proven, and beginner-friendly in every sense of the word. At the end of the day, the best investing strategy is the one you can stick to. If you pick VTI, set up automatic contributions, and stay the course through ups and downs, you'll already be ahead of most investors. Because the truth is, wealth isn't built on complexity, it's built on consistency. And for beginners, there's no simpler, more effective place to start than with the right ETF.